Welcome to the New Wealth Wave podcast hosted by Dr. Joaquin Wallace. We're diving deep into the intricate layers of the 7-stage generational wealth model to offer invaluable insights on legacy building, wealth accumulation and preservation, and financial growth across generations. I'm Dr. Joaquin Wallace, and this is the New Wealth Wave podcast. Hey, future wealth builders, this is Dr. Joaquin Wallace, and thank you for joining me on another episode of the New Wealth Wave podcast. Today, we are focusing on stage number 4, financial edification, and to help lead the discussion will be James Alexander, who is a certified financial planner. But before we get into the bio of Mr. Alexander, if this is your first time tapping into the New Wealth Wave podcast, make sure you hit the subscribe button right there below. And then you can get all of the notifications on our upcoming episodes. And also you can go back and look at some of our past episodes as well. And if this is your first time subscribing to the New Wealth Wave podcast or hearing the podcast, it's based on my 7-stage generational wealth model. You may say, what is that? So let me give you a little background on that. The model is based in 3 phases of our lives: the past, the present, and the future. Stage 1 is our internal and external ecosystem. Stage 2 is our financial genetic code, which we focus on financial anxiety and financial trauma. Stage 3, financial healing. This is where we provide tools to reprogram our financial genetic code as well, because we know that it came from stages 1 and 2. Stage 4, financial edification. That's where we're at today. And this is where we focus on financial literacy and inclusion. Stage 5, financial well-being. We don't want to outlive our income. Stage 6, generational knowledge. Generational wealth begins with generational knowledge to create our financial footprints to stage 7, generational wealth. And to help lead the discussion today will be James Alexander, who is a certified financial planner and partner with Edge Financial Advisor. He co-hosts Ed's Edge, a show geared towards regular, everyday investors looking to live a life of freedom. His approach integrates sound financial strategies with the understanding of the psychology of money, recognizing how emotions influence decisions. Based in Chicago with his family, James is passionate about empowering clients to navigate finance confidently. He emphasized the importance of emotional well-being in financial planning. Let's welcome James Alexander to the New Wealth Wave podcast.
Dr. Wallace, thank you so much for having me on. It's a pleasure speaking with you last week, and I look forward to our conversation today.
So, James, you had a chance to take a look at the 7-stage generational wealth model. What was your initial thoughts?
First and foremost, I love how you structured it. You know, I never thought of it in these stages until I spoke with yourself. The way you structure it with the past, present, future, they have to go in that order when we talk about building financial well-being, which is what you're referencing. And so I'm probably going to adopt some of these stages with your permission, but I think it's very, very well written and to that point structured.
Appreciate that. And you can use it. And that's the purpose of it all. To allow people like yourself to take the model and implement it and show it to your clients as well. So before we get into the heavy lifting of the program, because it's going to be some heavy lifting today, tell us a fun fact about yourself.
I'm a sports nut, first and foremost, but I use a lot of sports analogies when I talk about financial behavior. All that said, I have some nerd in me. I was a competitive chess player all throughout college, even a little bit after college, and I still teach it on the side today. So most people don't know that about myself. I love the game of chess.
And also we spoke last week, and we have something in common. We're both college baseball players. And it was interesting when we had the conversation. As baseball players, we're kind of nerdy. We understand that. We're very numbers driven. But most importantly, we understand the importance of fundamentals, which we're going to talk about today, because we need to really show our listeners there is the traditional financial theory that you have to adopt. But as you mentioned earlier, a lot of our decisions are based on the behavior of financial theory. We have the cognitive biases, heretics, things of that nature. We're going to get into a lot of those because it's so important to adopt the two. And the model speaks to that as well. Stages 1, 2, and 3 is really all about the behavioral financial theories, how we bring the emotions to the table. And stages 4 and 5 is based around the fundamentals, which is important to get to stage 5, which is our financial well-being. So this is going to be fun. I'm looking forward to it because you actually get it. You understand the importance of how the emotions impact our short-term and long-term decisions. This is going to be fun. I've been looking forward to this. So this is a 3-part question. Before you became who you are today, Where were you located on the model?
Sure. Yeah. Great question. So I'll give a short summary, a trip down memory lane for myself. So when I went to Loyola University in downtown Chicago, I originally wanted to be a math professor. And when I realized that wasn't a lot of fallback options on that degree, I ended up shifting over to finance and learning about finance. I bring this up to answer your question because I graduated with some significant student loan debt and I had a fixed W-2 income. And even when I grew up, we were a middle class family, but we lived incredibly frugally. And so I frame it this way because I was in stage 2 early on. I don't want to call it a poor individual mindset, but I kind of thought my life was fixed. Get out of debt. You know, you have X amount of money to live on, make it work. There's not a lot of upside here. There's not a lot of things that I could do despite majoring and learning about finance. And then I had some shift in outlook based on firsthand experiences in my career world that shaped the way I teach people today. So I was in stage 2 originally.
You know, that's interesting because we all came from a particular stage. Typically, we talked about stage 1, our internal and external ecosystem, how that plays a big part in shaping our financial genetic code, which again is so important because a lot of our decisions are emotionally driven. So with that being said, what was your aha moment that you realized that change was imminent?
It was one of those things where I thought to myself, okay, enough is enough. I have this debt. I want to get out of debt. But every time I thought about money, it created a little angst for me. And I view money as fuel to allow us to accomplish what we want in life. I want more fuel for the accomplishments I had as I wrote them down. And so that aha moment to me was I can do one of two things. I can lower my expenses, or I can increase my income. And let me be clear, there's no right or wrong answer, in my opinion, of you could lower your expenses, you could increase your income. Yes, I needed to be careful on my expenses, but I wanted to focus on increasing my income, not for any other reason that allowed me to accomplish certain things I wanted in life. So I wrote all those down. And in order to increase that income, I had to focus on myself and my skill set and be a sponge for information and learn from those who successfully did this. Nobody is agnostic to that. We can all create opportunity for ourselves depending on what we want. And that's the beauty of the world that we're in today compared to, say, 50 years ago. So my aha moment was, James, focus on yourself, focus on what you're passionate about, learn everything you can about it. And I'll preface maybe the final statement around macro patience. I needed to be patient with myself, but micro speed, day to day, learn as much as you can and don't stop until you're satisfied.
You know, we're constantly evolving, right? And it goes back to the baseball analogy. We had this conversation, which was funny. You know, baseball is one of the only sports that you can be 30% effective and make $1 billion. So you have to be patient in those 7 other at-bats, right? So you have 10 at-bats. Man, if you're 3 for 10, you can make a lot of money. But what happened to bats 4 through 10? You know, that's where the emotions come into play, but you go back and you rely on your fundamentals. I mean, that's so true. We're both kind of nerdy guys in terms of baseball.
Yeah.
But that's a whole different story, though. So final question for you. Where are you currently today on the model?
Yeah, I'm currently working in stage 5 as I look through it. I'm not there entirely yet, but I've been able to evolve within understanding stages 3 and 4 as I read it. I did it indirectly. I didn't know your model years ago, right? But indirectly, I did it, which is why I love it so much. So I'm currently in stage 5, working on, that financial well-being for my family and myself. And I'm eager to shift towards that generational model. I have a 5-year-old son right now. Now, he doesn't know some of these things quite yet. He knows that daddy helps people with their money, which I think is a win for him to understand that at 5 years old. All that said, I want to be able to pass this along, and not just assets. I want to be able to pass the teachings, the behaviors, which is infinitely more important in my mind than any asset someone could obtain.
I totally agree. So when we talk about generational wealth begins with generational knowledge, it's so important because yes, you can pass on assets, but most importantly, you have to pass on the knowledge because the knowledge is a perpetual. It will continue to grow and ascend, and you have to provide that information. Well, guess what? I'm at stage 5 too. So don't feel bad because we're all, we're helping people, but then at the same time, trying to get our financial well-being into place where we don't outlive our income as well. The stage 6, I'm kind of taking care of that. I have our estate plan in place, but stage 5, I'm working diligently to make sure my stage 5 is on point. So don't feel bad. We're all trying to get there as well. Let's get to the set of questions. So first question I have for you. So traditional finance assumes investors are rational, while behavioral finance recognize we have human quirks. Stage 4 and 7 of the generational wealth model emphasize the power of financial edification, literacy, and inclusion. which is important because you have to be able to set the foundation with stage 4. But as a CFP, how do you balance these perspectives, acknowledging human flexibility while empowering clients with knowledge to make better choices?
Yes. Oh, such a powerful question. I think we need to take a step back on that question and say, first and foremost, let's not be hard on ourselves about what we know and what we don't know, because we don't know what we don't know in this financial world if we're coming into this firsthand. They don't teach this in schools. And we can have a whole topic as to why. I have my own belief on that, but that's the matter of the fact. They don't teach this. So my mind is, don't judge yourselves about not knowing everything. But how do I approach that with my clients is I approach it strictly from an educational perspective, that edification you mentioned. There are pros and cons of every financial decision we make. And some people will say, well, this is the right way and this is the wrong way. And yes, the fundamentals are key to answering what's good and what's bad. But beyond that, my job is to educate them. And then they decide after understanding the pros and cons. Here's an example. I want to enjoy my 30s and my 40s, and I'm going to ignore the rest of the time. Yeah, I don't want to save, James. Let's just use that very basic. I don't want to save, right? As financial advisors, we say, well, that's obviously not the most ideal scenario because what about the future? That said, if I just tell someone you need to save, that's not going to work. It's not going to motivate them. Instead, the education I provide is, okay, here's what will work. Your 30s and your 40s will be great, but you might be working until you're 75 years old. That's the con because of the inability to have that freedom later. And that's the trade-off. And I'll explain some stories about clients that actually, in fact, did that and how that looks and tap into that feeling for them and really understand, do they like that or do they not like that? And more often than not in that example, they're going to say, well, gosh, I don't want to work till 75. And then I'll ask, how important is that to you? And we talk through that. And then we say, okay, let's make a little bit of sacrifice today. We can still enjoy some things, but we have to make sure that tomorrow's taken care of as well. So it's all back to education, pacing it, understanding it, and making decisions, knowing all facets of what could happen given what I want to accomplish. So that's the approach I take in a nutshell.
You know, when I meet with clients, I always mention to them CDC, choice, decision, consequence. And going from, you got to use that one, right? So, from that perspective, we talk about choice, decision, consequence. But most importantly, what I typically do with them, James, is I look at the financial planning model and I would say, listen, from ages 28 to 45, that's your accumulation phase. This is where you're going to accumulate most of your money because you're younger, you can work a little harder, so to speak, and those are longer work years. From 45 to 60, now that's the preservation of capital. So as we get closer and closer to that age 60, we need to be more risk averse, right? We have to understand we can't take that many chances, so to speak, but we have to be diligent and intentional about it as well. And then from ages 60 on, that's your gifting and that's your retirement phase. But one thing that I know that what I mentioned to the clients as well, at some point, you have to take some sort of risk. You have to.
You do.
Because you have to take risk. You have to be able to outpace inflation because you can go poor safely. And that's by investing in bonds and or CDs and things of that nature. Say, well, I never thought of it that way. Yet you're going poor safely. Right? So we have to take some chances to be able to outpace inflation. And again, as you mentioned earlier, it's really all about education because at the final analysis, our job is to provide the roadmap, the GPS for success, but they have to be a willing partner to do so. What are your thoughts on that?
Oh, so true. So true. I mean, the old adage of you can lead a horse to the water, you can't make them drink. You can encourage, but the decision has to be by ourselves in terms of taking that action. I want to take a step back on something that you mentioned that I absolutely love. This financial outlook and behavior is new because back in the 1950s, 1960s, it was a 9-to-5 job. I got a pension. 75% of the people received a pension and Social Security. And so there wasn't a lot of worry about the future because it was, companies were more loyal to you. You were loyal back. And so that's the stress that people have about, I have to figure all this out. But here's the pro. So much opportunity. Much more than there ever has in the past, to be able to accomplish things in their 40s and 50s that we couldn't have as many opportunities to do it early on. And so I think we need to celebrate that at the same time.
I agree. You look at the defined benefit plans. Now you have the defined contribution plans that you spoke about earlier. Defined contribution allows you to participate more so within the market itself. But again, you have to be educated and understand exactly what you're doing, because most of the time we don't have the knowledge or background. We use heretics, so to speak, when we're actually, making decisions, right? We don't really do the research. We want these mental shortcuts to make it work. And, I tell you again, I am so excited because we're nerds talking about behavioral finance, which is so important. And people really don't realize that that's how the model was actually constructed, with self-inventory on myself. So another question for you. Traditional finance expects us to make optimal choices, but behavioral finance knows that biases often lead us astray. So stage 4, we talk about financial edification. What do you do to overcome those biases while trying not to contradict their financial goals?
I actually have a lot of couples that I work with go through a very simple exercise to get laser focused on those goals, because that's the fundamentals, the foundation, right? As we talked about. So you call it a Venn diagram. I provide a little spin on it as I say, husband, you are going to write your own goals, what you want to accomplish in the next 5 years, 10, 15 years, so on and so forth. Wife, do the same. Do them separately. And that seems a little odd. But then I say, then come together and find the commonalities. And that's easy to overcome. And then we'll compromise in some of the differences that you may have. But those goals that are set out is my bedrock, my framework as to why we make those decisions. And it's my job to constantly remind them of that. And so I bring this up because there are so many biases we have. Well, my grandpa owned gold forever. And I said, yeah, he did. And it worked out so well. You found so peace of mind. Does gold get you to accomplish X, Y, Z that you just said? And more often than not, the answer is no. Or this hot stock was very, very cool. My neighbor just bought it. He doubled his money in a year. Great. Does that hot stock can accomplish what you want? So we need to play our game and be selfish about our game, not anybody else's. And so we're going to drive on our road. Yes, we might switch lanes if something changed along the way in our life, but staying driven and focused. And I become their accountability partner. And that's it. And so I tell my clients, when there's something that comes your way that seems exciting or fearful, let's talk about it. So it's more of a consultative approach from that point of view, let alone the math equations, right? Which that's traditional finances. When we do those goals, we have to make sure that the math checks out so that we can feel confident when we execute what we're going to execute. It's going to get us there, right? But there's going to be distractions along the way. And that goal-driven focus seems pretty obvious, is hard to execute consistently because we're humans. That's who we are.
So I have a deal for you. If I can use the Venn diagram and you can use the model, because I like that. That's a really good approach. You have them to put their goals and to see if they merge together. Can I use that?
You have a deal. We're going to make a trade here, Dr. Wallace. So that sounds great. Yes.
I love that. That's pretty unique. I like that. Future Wealth Builders, we're excited to have James Alexander, who is a certified financial planner and partner with Edge Financial Advisors. On our podcast, you can find us on Apple, YouTube, Spotify, and all the major social media platforms. Make sure you subscribe. Tell a friend, because we need you to be part of the Future Wealth Builders. Another question for you. So what I love about this, we talk about traditional finances and behavioral finance. We know what financial edification speaks on in terms of education, spiritually, morally, uplifting, giving you all the information to be a better person all the way around. We understand that. How can you take the model in stage 4? So if you're working with a client, you have stage 4, how can you integrate that particular piece of the model with your clients?
What I want to probably talk about first here with that is values and goals. Goals are different than values. So goals are what I want to accomplish. They're tangible and have time frames associated with them. Values are what I care about based on the past from stages 1, 2, and 3. But they're still synchronized. They're tied together because most of these goals are driven by values. I'll give you a firsthand example of myself. I had a lot of student debt. I was fortunate to pay that off. Now, the goal I have is for my son, when he goes to college or whatever that might look like in the future, not to have that burden for him. Meaning I value flexibility right after education. I value options. And so that education is going to be, okay, what does it take to accomplish those values that each of us have? What do we have to do today to make sure that we accomplish those values and those goals that we have tomorrow? I cannot, from a stage 4 perspective, project my own values onto anybody else. I have to listen to them and understand what is truly important to them. Because once I understand that, everything I say that drives towards what's important to them is going to be more motivating. And I can say all day long here, you need to save 15% of your income. You need to invest in these types of investments and all that, right? It's going to be a computer system. It's going to be nothing unless I care. Oh, I can do that. I can go to Hawaii every third year that I want. I can actually provide that support for my grandchildren. I can retire at 55. Those things are what we care about. And so we have to start there from an education standpoint, is understand what we want and then drive everything towards it. So hopefully that answers your question on how I provide that stage 4 help within traditional and behavioral. Traditional pieces, we got to make sure we run everything, stress test it beyond belief so that I can feel confident to say, you can do these things that you care about. It's a double-edged sword there.
Here's one thing. So I realized that once I was able to define what my personal stage 5 was, my financial well-being, that allowed me to place realistic expectations in myself. Therefore, I can really drive towards them. And I believe, going back to your Venn diagram, when you look at it from that perspective, people don't realize that each person in a union or in partnership have a different stage 5. And so without having the true definition of what are we trying to accomplish, and this is something that you have to look at probably every 10 years if you're fortunate to be with your partner for a long period of time, because things change. What we thought was important at when we first was married, or our unionship at age 25, whatever the case may be, to 35, changes from 35 to 45, 45 to 55, 55 to 65. So we have to have I call it work in progress. We have to constantly review, take notes, figure out what we need to do, but most importantly, talk with someone, right, that we trust to kind of go over our goals and aspirations, which we don't do, right? So oftentimes our financial fiduciaries are our barber, our dentist, so to speak, or our cousin, uncles, things of that nature, a friend who has no idea what's going on, or TikTok, whatever the case may be. But for the most part, you have to meet with those individuals like yourself that are professionals that listens to what the client wants, right? That's so important. But what I realized in this process, especially with couples, they come from 2 different ecosystems. So their stage 1s are different. They bring different anxieties and trauma. Their financial genetic codes are different. They may not have had financial healing. So when you look at those individuals, their stage 5s are different. So we have to figure out, what is that we're trying to accomplish? And again, as I said, once I was able to do that, it made it a lot easier for me to move forward, to put realistic expectations in front of myself. So I got a question for you, and this is a hot topic. We know that risk tolerance sheets are used a lot in the business, but those are flawed as well. What's your take on the risk tolerance forms?
I appreciate the way you said that, because it's true. Risk tolerance questionnaires have flaws in them. And why is that? So if I take a risk tolerance questionnaire and I'm 25 years old and I'm trying to build something and I'm super driven, I've got a lot of energy, I'm young, I might want to go gung-ho. And so my risk tolerance questionnaire is going to be very different than when I'm 27 years old and I just got laid off of my job and a baby's on the way. And now I got all these things I'm stressed about. I'm going to answer it probably much more conservatively. I need to protect the fort for my family. And so the stage of life that we're in will dictate a lot of what our tolerance for risk is. And so I take a step back with my clients and I say, okay, there's really 2 types of risk. There's risk capacity, which is the mathematical fundamental equation of how much risk do I need to take to accomplish these things that we wrote down from our goals and values. And that's, again, very critical, very important. It's spring training in baseball. Ooh, I need to get these things done, and I'm going to trust the process there. But then there's risk tolerance, which is my feelings around risk at that given moment of my life. And I'll give you an example of, I had a client who, when I first started working with her about a dozen years ago, I was a consultant. I was almost a stockbroker at the time, but I wanted to help her because she just didn't have a lot of people helping. And she was in her mid 50s and she had a mortgage. And she said, okay, I want to pay the minimum I can on my mortgage. I obviously don't want to default my mortgage, but I want to sock away for these reasons and all of that. Well, fast forward to last year, she's close to retirement. She had a change on her propensity around debt, where she said, James, you telling me I can retire soon. I know my mortgage rate is 3%. It's incredibly low. I am going to have so much stress if I'm retired and have this payment running over my head. And so the math stated, keep that 3%, invest things even conservatively, and you're going to make the difference, right? But that means nothing because she wouldn't be able to sleep at night, most likely, knowing she had this debt and didn't have any more earned income coming her way. We had to come up with a game plan around how can we get rid of this debt without sacrificing the math and making sure she can still accomplish what she wants. That's the type of risk I think that's more important is what do we need to take and what are we comfortable taking? And that comfortable taking is going to change depending on where we are in our life.
That's a great way of putting it because risk capacity and risk tolerance is something that most investors don't recognize. They don't understand as well. And oftentimes, we make decisions again in a vacuum. We see something, whatever it's crypto. I had a conversation about crypto a couple of days ago. And so, my theory on that in itself was, listen, as I said before, you always have to enjoy your life while you're here because tomorrow isn't promised. We know that. But I tell my clients, first and foremost, the first thing that your financial planner or advisor, someone who you're meeting with, there's three things that we always have to accomplish first. 3 areas. And I say the first thing, you have to plan for living too long. You have to plan for dying too soon. And you have to plan for becoming disabled along the way. Those are 3 absolutes. So whomever you meet with, those 3 need to be discussed because living too long is your stage 5, outliving our income. Dying too soon is our stage 6, generational knowledge. And becoming disabled away is our stage 6, generational knowledge in terms of long-term care and things of that nature. Because there's a likelihood that you're going to accomplish one of those 3 sooner than later, right? We all know we're going to pass on. We just don't know when, but we know that's going to happen. And we also know that there's a high chance of us becoming disabled along the way. Because the longer we live, the more the opportunity happens. We also know that living too long, we don't want to outlive our income because we know that financial health is financial wealth. Regardless of the money we have, financial health is so important. And oftentimes we don't look at it from that perspective. So with that being said, when you're meeting with your clients, how do you bridge the gap between reality and theory?
I'm going to tie it to what you had just mentioned around that financial health. Financial reality is let's lay all the cards out. And I have to stress this again because I've seen it firsthand with so many people how important it is. We cannot judge ourselves after we lay these cards out. I actually believe the reason most people don't go to a financial expert is, I'll use the word, some level of shame, or they're going to judge me. You have to just ignore that because again, you know what? 75% of the people in this world most likely are in the same position you are in some way, shape, or form. They're hiding it. And so we just have to be honest with ourselves that this is what I have. I have credit card debt. I have student loan debt. I have mortgages. I'm red every month. That's the financial reality. Or I am in the green, but I'm not as green as I want to be. And I'm worried I'm not going to be able to accomplish what I want. So that's the financial reality is lay all the cards out. Have somebody who knows and has seen this before help you with that. And it can be a spouse. It doesn't have to be a financial expert. But I have found that third parties often become better because they are unbiased. There is no of that stages 1, 2, and 3 that they've experienced about yourself, so they can help you overcome that. But that's the reality. Then the financial theory is we can't predict what will happen in the stock market and the economy and all these things. We can't predict it. If I could, I'd be on the beach having a Corona with you, Dr. Wallace, right now. We wouldn't be talking about what we're talking about right now. But we can plan for these events and plan for the unexpected. We can account for room for error. And so these financial theories we come up with this game plan on how it could work, but we have to realize there's going to be roadblocks along the way all the time. And there's going to be biases we're going to have. And there's going to be distractions from social media and the news headlines, which, by the way, the news is in business of creating fear. It's just how they make their money. So we have to realize they don't care about what we're trying to accomplish. They want to get us to watch tomorrow morning at 9 a.m. So we have all these biases. And that financial theory is, all right, if markets were to operate under the way they have the last 150 years with expansions and recessions, how is it going to look? What's the theoretical component of it all? And then are we motivated to take action towards those items? And so how close are we from reality to the future and to today? That's, I think, something that we miss out on is we have this financial reality of I'm in a bad place. I feel like I'm digging my own grave here and I don't know what to do. So I'm just going to ignore it. Please don't. Your 80-year-old self's going to look back at your 40-year-old self and not be too happy if you do. When you have time, let's just get after it.
So you're talking about hindsight bias.
Yeah, that's right. That's right.
Oh,
there's so many biases on that.
There's
Exactly.
so many biases. Future Wealth Builders, we are excited to have James Alexander, certified financial planner and partner with Edge Financial Advisors on our podcast today. You can find us on Apple, YouTube, Spotify, and all your major social media platforms. Make sure you subscribe and ride the wave with us and share with your friends as well, because this is some great content that we're speaking of today. So on that note of biases, what common behavioral biases do you encounter with clients, and how do you help them overcome them to make sound financial decisions? I know you have a lot of them.
Yeah, I'll do my best to simplify, Dr. Wallace. There's so many. Probably the most common one is confirmation bias, which is I want it to be true, therefore I believe it to be true, therefore it must be true, and anyone that says anything else is wrong. And it all starts with the fact that I kind of want it to be true. And we're not going to talk politics today, but I'm going to give a story along these lines of, we know our new administration, our new president. If you are not a fan of that, you most likely have a confirmation bias that the economy is going to struggle over the next 4 years. And so what happens is you're going to go on your iPhone, you're going to say concerns about the Trump administration. And Apple is a very smart software device. I don't know the ins and outs of it, but what I do know is it knows that you think there's going to be concerns. And so it's going to keep sending you articles unbeknownst to you within all your apps around problems. And so it's going to confirm what you think to be true. Conversely, you think the Trump administration is going to be wonderful. You're going to say all the great things, and it's going to do the same thing on the other side. And so it is convincing you to be true when the fact of the matter is the president has very little impact on the overall outlook of stock earnings, which drive stock markets. They have some, but not as much as we are led to believe. So confirmation bias is a big one. The herd approach is probably the second biggest one. Gosh, everyone else is buying crypto. I'm missing out. Fear of missing out. I must be buying crypto. What is going to happen if I don't do it? Am I going to not be able to retire when I want? Am I going to not have the wealth that my neighbor's going to have? And that's going to be bad. He's going to have his new patio and I'm not because I didn't buy crypto, right? That's the herd approach of everyone else just doing it. And that's where I go back to playing your own game. And maybe the final one is that recency bias. That stock worked. Let's get another one, right? So you took a massive risk and it worked out. And now you think you're a genius. Let me be clear. I don't want to dismiss any of those wonderful profits that people make, but we have a saying, at least in our company, of let's not mistake the bull market for brilliance. And so, you get on that wheel and wheel and wheel, and eventually something's going to pop. And when it does pop, often you're taking more risks than you really should. And then you're back to square one and all that's for naught. So anyways, those are probably the top three. How do I overcome them? In summary, I go back to those objectives. Instead of just challenging them on confirmation bias, I want to dig a little deeper and inquire of why do you think that to be the case? What did you read about that? Help me understand where that logic came from, where those emotions came from. And I need to be the bad guy sometimes, respectfully, of what if it's wrong? What if that didn't happen? What impact would that make in your financial life? And when we have these biases, we don't think we're wrong. So if we overexpose ourselves to something that may or may not be in fact true, and we are wrong, that's when problems arise. A lot of what I do within this component to that question is avoiding people from making mistakes, let alone optimizing their financial assets.
We may have to bring you back because we could do a whole episode on biases. I mean, that's a whole different level in itself because you hear it all the time. We see it on TV. Like you mentioned, herding is one, for example. You hear that all the time in regards to the crypto. Like I said, I had a conversation in regards to that as well. I said, listen, if you want to play in that sandbox, that's okay. Take some money, a little bit of money, And you can do that. You don't have to put all your eggs in one basket. And if you're looking at tactical, so to speak, then, do a core satellite portfolio, something along those lines, where you can have, 70% in more strategic, rebalancing in that direction, diversification, non-correlated assets. You could do that. And then tactical, you can chase the market, right? But we know that EMH specifically says you can't outpace the market because all the information is out there. But, if you want to do tactical, you want to spend some money, that's fine. Do that too. I have no problems with that. That's your money to do.
Just make sure it's money that you can afford to make a mistake on. That's it.
Exactly.
Just and you can have fun with the game.
Have fun with the game. It's not a problem. Do that. It's no big thing. But at the final analysis, no, we have to be smarter with our decision. And I really do appreciate you mentioning that because that is so critical. So another question for you. We talk about in terms of the panic mode, market downturns, things of that nature. How do you use behavioral finance principles to help clients stay disciplined and avoid emotional reactions that can derail their long-term financial plans?
Going back to avoiding making mistakes, part of that is staying disciplined, which is easy to say, hard to do all the time. And so what I do is, if those listening, if you can visualize this, I'll draw a chart of the United States stock market, call it the S&P 500, over a long period of time, call it 20 years. And there's the ups and there's the downs, right? I'll say, let's pretend the next 20 years is this exact chart. When is the best time to get in? And people look, well, at the bottom, right? We want to buy low. When is the best time to quote unquote get out? And they're going to say at the top, right? Okay, how do you know when that's going to be the case? And how do you know when it's the bottom? Is it going to go lower than this? And it gets us thinking about, it's going to be next to impossible to time this thing. With the right strategies, we can be tactical, but we can't time the market. Then I have to remind them about that sometimes. But on that bottom, I'm going to say, okay, the best time is to take on more risk, whatever the case may be. Do we believe in the global growth of the United States economy? That's probably one of the most important questions we need to answer. If we believe that the world is going to grow, then this is why we're investing. So at that bottom point, I read to them, we'll use 2008, 2009, when I first started in this business. And I was, again, a stockbroker. I saw people make some wild mistakes. And I'll say, I'm going to read you some headlines from that housing market crisis. And I'll say, do you remember that? What were you thinking then? What happened then? And the minute we hit our top and things were going down, I'm going to read you some headlines there. You were thrilled. You were excited. And so I write some of the emotions, common emotions along this path before we even get into the investing, so we can understand, look, I have a joke even when my grandma calls me and says, I'm worried about the stock market. It's reached its bottom. So knowing these headlines and knowing these things, if I set that stage right, we understand it right, it's easy to go back to it when we feel it, when we understand it. And probably the final piece to this that helps shape some of the overcoming these emotions with stock market volatility is time frame. So if I need the money in a year, obviously I shouldn't be investing in individual stocks or anything in the stock market for that bucket of money. But if I need it in 10 years and the stock market's down and we're worried, I'm going to ask them, has anything changed on that time frame? If the answer is no, do you believe the market will come back over the next 9 years? If the answer is also no, we have to have a different conversation. But if the answer is yes, then, I can even play devil's advocate. Well, let's put more in. Well, I don't want to do that. We talk through this as our feelings individually, especially as it relates to our time frame and our goals. And this helps avoid the distractions of the 2008 headline of the economy is going to collapse, our world's coming to an end, Lehman Brothers is out, et cetera. So anyways, it's a fun exercise I like to do. And I do it individually as well.
You know what? I appreciate this conversation again. I'm having so much fun with this. I mean, two baseball players talking about fundamentals, talking about behavioral, because we've both been in that situation where we're 0 for our last 10 and we're just emotionally just done, right?
I'm due.
I'm due. And then you get 3 hits and then you feel like you're on top of the world, right? It changes emotionally. And then your coach is saying, you got to go back to the fundamentals. You got to go back to the fundamentals, right? Yeah. You're like, but, oftentimes, now you have launch angles and things of that nature. No, let's get back to the fundamentals, go through the baseball. But I'm going to take you up on that. We're going to go and have a Corona and go to Wrigley Field. That's what we're going to do, right? We're going to do that. We got to do that.
Season tickets, so let's do it.
We're all over that. I'm coming in the summer, buddy. Trust on that. Future Wealth Builders, we're excited to have James Alexander, certified financial planner and partner with Edge Financial Advisors on our podcast. today. You can find us on Apple, YouTube, Spotify, and all the major social media platforms. I hope that you enjoyed this particular episode because we tackled stage 4, but we add a little twist to it, some traditional financial theory, some behavioral financial theory. A couple final questions for you. What do you want the listeners to take away from this podcast?
Point number 1 is write down what you want, but stay focused on what you want. Emphasis on what you want in life, not what your neighbor wants, not what the news is telling you. Laser focused on that. Number 2, along that focus is educate yourself. You're not taught this. You have to be proactive about that education for yourself. And I'm not talking about certified financial planner education. I'm talking about those fundamentals that we keep going back to of what do I need to do? What are some of these common traits and behaviors that I need to do to get myself in a better place? And then a third nuance as a takeaway is while you're doing those things, understand that life is not linear. There's going to be different stages of your life and it will change and, go figure, right? That's what makes it exciting. If I knew exactly what I would be doing when I'm 65 years old, it would be probably a boring life, but it's also nerve-wracking potentially. And so accounting for room for error along the way, give yourself some slack, but yet still stay focused and stay motivated.
So, James, you mean to tell me that financial literacy is not a linear process?
It's not, Dr. Wallace.
Oh, wow. What a novel thought. Wow. That's been my main argument. It's not a linear process. So tell the listeners, how they can get in contact with you and if there's any other projects that you have going on as well.
Certainly. So how you can contact myself, our website is EDGEFA, F as in Frank, A as in Apple.com. I'm right there on the website. We have an educational-based podcast as well. It's called Ed's Edge, as you had mentioned so kindly earlier, Dr. Wallace. So you can check that out. And we talk about certainly behavioral finance topics, but not as deeply as I just did with you. So I absolutely thank you for that. Any projects I'm working on, the biggest project I keep working on myself is making sure that everybody that I work with, that I connect with, I'm only one individual. I want them to feel that personal touch. And so from our practice standpoint, I'm working on expanding out the team here. So everyone knows and to like-minded members along what we're talking about today. So that is one of the challenges I have from a business perspective is making sure that we build it out. But it's a journey and you got to enjoy it.
Feel free that you can use the model as well. Oftentimes I'm finding a lot of individuals that come on the podcast, such as yourself, they're actually referring their clients to specific episodes, your episode of the podcast first before they meet with you, because it gives them a general idea of, what to expect. So I take that as a compliment now. People are saying, hey, I send out my clients a specific episode of the podcast because it speaks to what I want to talk about as well as kind of primes them when they come in as well. So feel free to do that as well. Future Wealth Builders, we are excited to have James Alexander, certified financial planner and partner with Edge Financial Advisors on our podcast this afternoon. On behalf of the Future Wealth Builders, my producer, Ray Haycraft, and myself, we'd like to say thank you for coming on the New Wealth Wave podcast. And as we always say, generational wealth begins with generational knowledge. We'll see you on the next New Wealth Wave podcast.
Thank you for joining us on the New Wealth Wave podcast, hosted by Dr. Joaquin Wallace. Our show is edited and produced by Ray Haycraft. To dive deeper into the world of financial wisdom and learn how to create your financial footprints, head to our website at www.drjwallace.com. For more updates and exclusive content, connect with us on social media by searching Dr. Joaquin Wallace. And if you have questions and comments, feel free to email us at thenewwealthwavepodcast@gmail.com. Remember, generational wealth begins with generational knowledge. And as always, thanks for listening. The content presented in this podcast is strictly for educational purposes and should not be taken as investment advice. The views and opinions expressed by our guests may not necessarily reflect those of the New Wealth Wave podcast and its host or producers. Listeners are urged to exercise discretion and judgment before making any financial or investment decisions. Always consult with a financial professional or advisor before taking any action based on the content of this podcast. If you're enjoying the New Wealth Wave podcast, we appreciate if you leave us a review. We're always open to topic suggestions and guest recommendations. Feel free to reach out to us directly with your thoughts and feedback. Thank you for tuning in, and we'll see you next time. on the New Wealth Wave podcast.